For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
All right, time once again, another fabulous episode. There I go again, top of the episode, telling everybody how fabulous this is going to be. And now I got to live up to that. Professor Rick Plum, certified financial planner professional, such as you are. I've set the bar very, very high. I said fabulous episode. That means both you and I have to live up to this. Are you ready?
Always ready. Always ready.
Okay. All right. Good to know. Welcome to the program. This is Managing Your Financial Future. I'm your podcast host, Johnny Dean. We are here for the next whatever, talking to you about some important topics. And one of the things that we haven't talked about for a little while, but seems to be on people's minds, only because we had brought up the topic but didn't talk about it a couple of weeks ago, has to do with Roth IRAs. I am surprised, Professor, that there's so much confusion about Roth IRAs. Now, maybe because you and I talk about them a lot, but it seems to me that they're fairly, the rules are fairly straightforward, but maybe not.
Well, the idea seems very straightforward, but then there's some different rules regarding the IRA's withdrawals and things of that nature. There's a difference. There's a 5-year rule, and there's actually more than one 5-year rule. When it comes to what is it that you are potentially withdrawing from the Roth. Now we're talking about specifically IRAs, but there's a lot of crossover between the 5-year rules, between IRAs and Roth 401ks or Roth retirement plans at work. There's the Roth TSP, the Roth 401k, the Roth 403b. So there are some other, but they all kind of work in the same way. Roth IRAs, the big difference between the two sets of retirement plans is the amount that you can contribute to one or the other.
Yeah.
Traditional IRA, Roth IRA, total combination of contribution for any given year is $7,000. If you're 50 plus, or you will be 50 in this year or later or older, you can do $8,000 into the Roth IRA. Mm-hmm. The retirement plan side, where you're doing a salary deferral of some sort, whether it's 403b, 401k, TSP, whatever, you have a $23,500 contribution maximum to the Roth 401k. I'll use that generically, and another $7,500 if you're going to be or are 50 years of age or older this year.
Yeah, a lot of numbers there, and the basic rule of the Roth or benefit of the Roth, Professor, is you put in post-tax money into this IRA. You pay taxes on it now. It goes
There's no
in there.
Immediate tax benefit for contributing to a Roth IRA.
No, but if it grew from $10,000 to $1 million, I'm saying
go for it.
That's what you want, because there's no tax on the withdrawal after you have satisfied the requirements. And there aren't a lot of requirements, but there are some that allow you to take the money out tax free.
Right, and the basic requirements are, if we're talking about the Roth IRA, you have to reach 59 and a half and have had a Roth IRA continuously for at least 5 tax years.
Yeah.
Now, on the other side, the same rules apply to the 401k, 403b, for whatever the retirement plan is. Where people get into a little bit of trouble is if they've only have the Roth 401k. And so they've been working along, contributing, building up a big Roth 401k. And then they roll it over to an IRA when they retire, a Roth IRA when they retire. And sometimes they get caught with this, because then they start taking money out of the Roth IRA. Now, they've had the Roth 401k for the past 15 years. They've been contributing to it, the $23,000, the $31,000, whatever the number was for the year. And so they've built up a lot of contributions into that. And they've got a lot of earnings. And then they move it all over to an IRA. Now they start taking distributions from a traditional or from a Roth IRA. But they get a notice that says, hey, wait a minute. Now if I'm taking what they call a qualified distribution from a Roth IRA from my IRA, if I've had that Roth IRA for 5 years and I'm at least 59 and a half, it doesn't show up anywhere on the tax return. In fact, the IRS or the Roth IRA people may not even send them a 1099. You don't even account for it. But if I've only had the IRA for a year or less than 5 years, and I start taking money out of it, the IRA custodian is going to send a notice to the IRS that says, this is not a qualified distribution. Make sure that you get the right documentation.
Yeah.
It's still going to be tax-free unless you take 100% out, because the contributions will come out tax-free. But the IRS may send you a little nasty gram. Your heart's going to skip a beat, because that's what happens when we get that dang thing from the IRS. Even though we know we just have to account for it correctly, we have to deal with them. And we don't want to have to deal with them.
No.
Because in this case, we haven't had the IRA long enough to take a qualified distribution. So then we have to file another form that says, yeah, Mr. IRS, we know it's not a qualified distribution, but it is our own money that we're taking out. It is our contribution base that's coming out. And as long as I don't take any earnings out within the first 5 years of rolling it to the IRA, assuming I don't have any other Roth IRAs, I'm still tax-free.
Mm-hmm.
So leave me alone. But just dealing with the IRS sucks.
It can be bad. And now there are limits, as you said, to putting money into a contribution to any IRA, whether it's a traditional IRA, Roth, or whatever. Is what did you say? Is it 7,000 for this year, and then the catch up is an extra 1,000?
Yeah, 7,000 with a 1,000 catch up for age 50 and older. And like I said, it's not 50 right now. So if I turn 50 December 30th of 2025. I can make my contribution right now for the 2025 age 50 plus.
Well,
I don't have to wait. I just have to wait until the year that I reach 50 to start putting same thing with the 401k, the extra $7,500 contribution salary deferral age 50 or over. I don't have to wait till the day I turn 50 or to be able to contribute that extra $7,500. I just have to wait till the year that I'm going to reach 50, and I can start contributing January, February, March, spread it out over the whole year if I want to.
Yeah, and
get that extra $7,500 in.
Yeah, and maybe you should. I don't know. That's up to you. But here's the thing. So you're limited to the 7,000, 8,000, whatever it happens to be for you. And you're also limited, Professor Plum, as far as income goes. There is an upper limit to the income for a Roth IRA, which generally tends to go up each year. And for 2025, those limits are?
Well, you start to lose the ability. Now, it depends on whether you're married or single. If you're a married person and your household income, your adjusted gross income is more than $236,000, you start losing the ability to contribute the full amount. And once you get to $246,000 of adjusted gross income, you've lost all ability to contribute directly to a Roth IRA. You can't do a Roth IRA direct contribution as a married couple with your adjusted gross income of 246. Single, my eyes are horrible, 150 to 1 or 160 to 185.
Okay, so you have a
no, 150 to 165. I need to put my glasses on.
You're looking at the 2027 table, I think, not the 2025 table.
It'll be there soon enough.
You've looked ahead, yeah. So this is a limitation to the Roth IRA on the contributory side. Now
it's not for the rich. If you make too much money, you cannot contribute to the Roth IRA.
True, but it doesn't mean you can't get money into an IRA. And this is what
a
Roth IRA. This is what's going to the whole point of the topic of this particular episode has to do with supersizing your Roth IRA. Some people call it a Mega-Roth. Some people call it a Super-Roth. I don't know, but it's a way for you to get money into a Roth IRA, even if you're, we'll say, a highly compensated employee somewhere, highly compensated individual who is over those limits. Professor Plum, let's go through the steps of turning your lack of ability to contribute to a Roth into a Super-Roth for you.
Well, there's two ways, and the way you're looking at it is a specific type of allowable requirement at your current employer 401k. We'll talk about 401ks in generic as for retirement plans. Or there's two ways. So you either have the ability at your employment to do what you're talking about, the super mega Roth, or you do a backdoor Roth. We're going to skip the backdoor Roth contribution for now.
Yep.
That is where you make a non-deductible contribution to a traditional IRA and then convert it to a Roth IRA. That is totally legal. The IRS has blessed it. Everything works fine. We've talked about it before. What you're talking about, John, is something that has been called, as you mentioned, the mega backdoor Roth. And it's if you have a 401k at work where they allow an additional contribution over and above the salary deferral limit. So I do my normal salary deferral into the Roth 401k. There is no AGI limitation on the Roth 401k. So it doesn't matter how much my adjusted gross income is. If I want, I can forego the tax deduction with the traditional 401k and do my entire contribution Roth 401k. I could be making $500,000, $600,000, $800,000 a year and still contribute to a Roth 401k. Can't do a Roth IRA, but I can do the Roth 401k. But that's limited to that $23,500 or $31,000, depending upon your age. However, there is another area of it's a little bit less known, where some plans, not all plans, but more and more are doing it as more and more people are asking their employers to push the envelope a little bit. Although it's not pushing the envelope, it's been blessed, it's okay. Mm-hmm. The 401k just has to be written or amended to allow for it. Over and above the salary deferral. Now, the company, you are allowed to, between the company and the employee, you're allowed to put $70,000 into a 401k in any given year.
$70,000, which is obviously way above the $23,500 or $30,000.
Yeah, there's an extra $56,500 that the company can put in on your behalf. Now, that though, it is the way it works. And so that typically, if the company is offering a very large profit sharing plan or a very large match, I have not seen one this high yet. You may already be getting that. That would be extremely unusual. Most companies put a small match in, half of what you're putting in or something of that nature. But there's usually some room left on that current $70,000 limitation. So what the IRS is allowing is that you can do additional after-tax contributions to the traditional side of the house. You are putting you've already maxed out your $23,000. You say, okay, I'm going to put in more money from an after-tax contribution. It doesn't go into the Roth. Not directly. It goes into the traditional side of the house.
Now, your company has to allow, as you said, your company has
to be written to allow it.
Allow after-tax contributions into the traditional 401k.
Right. So
not all companies do.
Right. So let's say I'm putting in my 23. I'm not 50 years of age. I'm putting in my 23.5. The company's putting in 6,500 as a match. So the combination of the two of them, between what I'm putting in and what the company's already putting in, is $30,000. The defined contribution limit is $70,000. So I could, assuming I have enough cash flow to be able to support this, put another $40,000 into the plan. $40,000. I put it into the after-tax side of the traditional IRA. And then I instruct the company to convert that after-tax money to Roth. So I'm putting it into the after-tax side, but I'm converting it to the Roth IRA. So I'm basically increasing my Roth contribution significantly.
Now,
now not all companies allow that. So there's different ways to do it, but that's what we're looking. That's the best of the best of the best.
So let's be clear as to what we're talking about here. You have a company. Your company has to have the ability to put in after-tax money into into the traditional 401k. They have to allow that first, right?
Right. That is not available in all plans.
Yes.
Although it's becoming more prevalent, it's still not a majority of plans yet.
So let's say the company does that. They do allow that. The maximum amount that you can defer into anything in this particular instance is $70,000 total, and that includes the match that the company is giving you. That includes your regular contributions and all that stuff. When you put in the after-tax money into your 401k and you reach that, let's call it the $70,000 limit, you talked about moving that money from the after-tax 401k account
from the 401k account to the Roth IRA.
To a Roth IRA. Now, to the Roth
401k.
There you go. That's what I wanted to make sure.
To the Roth 401k. You're staying in the 401k world. You're moving from, the traditional to the Roth, and it's a way to basically do a backdoor Roth 401k.
Yes. Now, okay, if your 401k has earnings, I don't know if I want to get into that, But if your
But you're doing it
401k,
as fast as possible.
right away. Now, there may be let's say your company doesn't have a Roth 401k, but they allow after-tax money to go into the traditional 401k.
You have now an accounting ledger for the after-tax contributions that you've made to your plan. So in this wholly hypothetical, I put in my $40,000 of after-tax, and I'm doing it for 5 years. So over that 5-year period of time, I put 40, 40, 40, 40, 40, 40, and I've put in $200,000 in after-tax money.
After 5 years.
Yeah, after 5 years. The earnings are still pre-tax. So the earnings are over there. But now I terminate my employment, and I have a $200,000 account of, it's not an actual investment, it's just an accounting issue. $200,000 of whatever that traditional 401k is worth is after-tax money. So let's say that the 401k is worth $1 million. When I terminate, I instruct the 401k company to roll it. If I've decided to roll it to an IRA, which you probably would at this point, I'm going to roll $800,000. That's all the pre-tax money and all the earnings to a traditional IRA, and I'm going to move that $200,000 of after-tax to a Roth IRA. Again, this has been blessed by the IRS.
Now
totally legit.
And to do that, you have to have severed employment. Is that correct?
Right. You have to sever employment to do that.
But you don't have to do it if your company does have a Roth 401k. You can do it.
And most companies nowadays, I have not seen a plan that does not have the Roth component to it, assuming there's more than like just family members involved. I mean, if it's a company that has, more than 10 or 15, 20 employees, they typically will have both traditional and Roth 401k plans available. So they're becoming more prevalent.
They are. We talked about this a long time ago. On our, I think it was on our TV show or radio show, a good 8, 9, 10 years ago, I think. And Roth 401ks were a lot less common,
a lot less prevalent. Yeah.
Yeah.
Now they basically if you're opening one, it typically will have. If it's a company that has, like I said, other than a very specific, like a one-person solo K, where they know that they don't want the Roth side of it, then they just do the traditional. But that's just the life of the city.
Yeah. Now you've got to have a whole lot of extra money to be able to save to do this. Obviously.
Well, yeah. Typically, if you're trying to save $70,000 a year or some number like that, you got some pretty good income. So it's either you and your spouse both have very good incomes, or you have significant income to be able to save that much money on your own as a single individual. But it's there. And so a lot of times we'll see this, a lot of times we'll see it with a second income, where a spouse has received an income now and the household bills are getting under control and they have the ability to play catch up and they want to sock away as much as possible. Or, you're lucky enough to be making that 5, 6, 7, 800,000 or more a year. What a shame.
Well,
if you're making $800,000 a year and you're only saving $70,000, it's not even 10%. You got to figure out a way to save some money. You should be saving more than $70,000 a year if you're making $800,000. You should be saving, $100,000 a year more, because that's what it's going to take for you to retire in your world. Well,
that's true, and this goes back to
just life in the big city.
Yeah, this goes back to spending more than you make and all that kind of stuff. You have to have a predilection for being able to save. But if you are in that camp, this can be a really good way to get money into the Roth world, because really, Professor Plum, the more money you have in the Roth world, when it comes time to take that money out when you're retired and all that stuff, I mean, Roth IRA, Roth money makes things so much easier.
It gives you a great deal of flexibility.
Yeah.
Because you can then use your 401k, your traditional IRAs, and use them as judiciously as possible to work on your taxes. Then any other money you need, it's all tax-free. It's wonderful. Well, and so when we're talking about this, though, we're talking about putting money into the after-tax component of the traditional IRA. Or the 401k. If I can't do this, if I can't roll it to a Roth IRA, I'm not sure I really want to, other than the ability to do this Roth side of it. I don't necessarily want to build it up inside the after-tax component inside the 401k, because then you got your earnings are tax deferred. They're part of your IRA in the ultimate. Mm-hmm. They're part of your required minimum distribution. They're not capital gain. They're ordinary income. But if I've got the ability to do this Roth side of it, this Mega-Roth, this mega backdoor Roth, I mean, if somebody could wave a magic wand and there's no cost for me to do this, would I rather have traditional IRA, Roth IRA, or personal money in a large account? Every time I want Roth. It's the difference is what did it cost me to get there? And in this hypothetical, I said there was no cost to get there, so I want it all Roth. But it's very difficult to build up that Roth IRA and have that massive Roth IRA when I retire based on the amount of taxes I'm paying today. It's like I really don't want to forego that good tax deduction today to be able to get the tax benefits in the future, which may or may not equal what the tax benefit is today. And so if I didn't have a cost, I want Roth. And in this case, we're talking about after-tax money in all these cases. And so my after-tax money choices are invest personally. That's fine. It gives me capital gains, but I have to pay taxes on the earnings as they occur. After-tax money in a traditional side, if I can't get it to Roth, I'm not a big fan of that at all. Because that, as I mentioned, becomes part of my RMD, becomes taxable. I got to keep track of it. I got to account for it on my tax returns. It's a pain in the keister. After-tax money going into a Roth IRA, number one good thing. That is as good as it gets.
We talk about you mentioned having after-tax money inside of a traditional IRA.
That's horrible.
And well, it's horrible in the sense that, as you just said, you're going to be married to, is that E206, the form? Yep. When you take it out, it's got to be pro rata. It can also mess you up if you have after-tax money inside of a traditional IRA and you try to do the backdoor Roth strategy that we talked about. It could kind of mess you up from an accounting standpoint when you try to do this stuff. Do you want to explain that here?
Tax standpoint.
Yeah.
And it's not the after-tax money in the traditional IRA that messes up a backdoor Roth. It's the pre-tax money in an IRA along with after-tax money in an IRA. Now, we're talking about the IRAs only here. So if I have existing money in my traditional IRA, the backdoor Roth doesn't work. Because the whole idea of doing a backdoor Roth is to be able to do an after-tax contribution and convert it tax-free to a Roth. Yes, if I have an IRA with pre-tax money in it, I can do the after-tax contribution, assuming I'm over those limits. I can't deduct it, but I cannot do the tax-free. I can't do step 2 of that Roth 2-step. I can't do the tax-free conversion from the traditional IRA to the Roth IRA.
Give an example.
There's already money in the IRA.
If you would, give an example so people could follow what we're talking about. Make it some easy numbers just to illustrate this, if you would.
Okay, I've got money in my traditional IRA. I've got $90,000 in it.
And that's all pre-tax money.
It's all pre-tax. It was from a former 401k that I rolled over or whatever. Now it's worth, $90,000. It's February. I do a $7,000 after tax. So I do a $7,000 contribution to my traditional IRA. Now in this case, I make, call it $300,000 between my spouse and I. So which means, and I have a 401k. I just mentioned that, or let's just say I do. I cannot deduct the contribution to that IRA. I also cannot contribute directly to a Roth IRA. But I made that contribution I can always contribute to a traditional IRA. I just cannot deduct it. So now I have $7,000 of after-tax money in my IRA, and I turn around and I convert that to a Roth IRA. Just $7,000 in, convert it over $7,000 to my Roth IRA.
You try to.
And then next year comes around when I have to account for it on my tax return. So the $90,000 in my traditional IRA that was there beforehand, it was a different account number. It had a different brokerage company. It was completely separate. It had nothing to do with the money I converted over to the Roth IRA in February. But that's $90,000 has now grown to $93,000 by December 31st. When I do my tax return, I have to fill out the Form 8606 and say that, yes, I made a $7,000 after-tax contribution to my Roth IRA, or to my traditional IRA. And then the next section, I have to say, okay, I converted money. But what they're going to do is they're going to say, what was the value of your IRA at the end of the year? And in my example, it was $93,000. How much money did you convert during the year from your traditional IRA to your Roth IRA? I converted $7,000. And that means that 7%, 7,000 out of a total of 100,000 in my IRA for the year, was after-tax money. So when they say, okay, 7,000 was converted, 7% of that conversion is after-tax money, and 93% of it is pre-tax money.
Meaning you're going to be paying taxes on 93%.
All right.
You thought you
also
would have
means I've left money, after-tax money, in the traditional IRA. So now I got to file that dadgum Form 8606 every year that I take money out of that IRA or add money to the after-tax side of the traditional IRA. It just doesn't work. So you do not want to have pre-tax money or any pre-tax IRA money out there. And as I said, it doesn't have to, we're not talking about the same account. Any account in your name. If your spouse has money in the after-tax or pre-tax, that's fine if you're doing it for yourself. It's a matter of how much money do you have in traditional IRAs in your name? And that can screw up. Now, what you can do in many cases, if you want, is take all the pre-tax money that you have. You take whatever pre-tax money, and if your 401k allows, you roll it into your 401k. And now you don't have any pre-tax money in your traditional IRA. Mm-hmm. And the 401k is a separate entity. It doesn't count. They're only looking at your IRAs. Now you can start doing backdoor Roth IRAs. But beware. A lot of people, not a lot, but I've seen this happen where somebody has been doing the backdoor Roth. They've done it successfully. They have no money in their traditional IRA. They've been doing their $7,000, $8,000 based on age into the traditional IRA after tax and then converting it to a Roth, doing the same thing. They do it early every year because they want as much growth, hopefully, as possible, so they get it in as early as possible. And then towards the end of the year, October-ish, August, September, October, they terminate employment. They retire or they leave their current employment, and they take the 401k from their current employer and they roll it over to an IRA. Now, when they did the Roth contribution or the two-step Roth in January, February, they did not have any other IRA money. But the IRS doesn't look at that point in time. The IRS looks at 12/31 of that year. Yeah. Do you have an IRA balance on 12/31? Yeah, I rolled over $1,300,000 or some number. And that means that your proration of how much of that $7,000, $8,000 that got moved over on the Roth is a very tiny number. And it just shoots yourself in the foot.
So you're going to wind up paying taxes on that. The point is that...
So make sure you wait to roll over that 401k until the next tax year.
Yeah, as soon as you mix pre-tax money with post-tax money inside of an IRA, you cannot separate those two. For the very most part, you cannot separate those two. It is very difficult. Now, if that was a lot of abstract stuff, let me just put this in real simple terms, if I may, and you might appreciate this. I've got a bowl of Captain Crunch with crunch berries, and I want to separate the crunch berries because I want to eat those from the Captain Crunch, right? Both are good, but I'd like to have the crunch berries. Well, in this will not allow me to take just crunch berries, all the crunch berries out of the bowl. All right, I have to take, for every crunch berry, I have to take a proportional amount of regular Captain Crunch. Is that just? I'm sitting here thinking of
Now you're making me hungry.
I know.
I haven't had Captain Crunch
since college. Since college. Oh, and they didn't.
It used to rip your mouth up when you would eat it dry, but man,
it was so good. It was so good. So I'm just trying to make it a little easier, and I'm trying to have some fun with this. But
I mean, for people that do have after-tax money, there are two things you consider to, as you mentioned, separate pre-tax and post-tax. One is the way I mentioned, if you're still working and your 401k allows, you can roll it all into your 401k. Now, the 401k will not allow after-tax money to be rolled back into the 401k. It's prohibited. You can't do it. So the only money that can go over is the pre-tax money. Thereby, you can separate pre-tax and post-tax. But what if you're not working? Whatever. Then when you're out into RMD age 73 and older, 75 in a couple of years, a QCD will only come from the pre-tax side.
That's a qualified charitable distribution, donation, whatever.
And so you can separate them in that fact where only the pre-tax money is used for that, and it will satisfy your RMD.
There are ways to do it, but
it's a pain.
It is a pain, and I realize that these are a lot of numbers we're throwing out at people here, and I realize that there are a lot of rules and things like that. I'm hoping we're not being too confusing here, but just to go back to what our point was in the original part, which was supersizing your Roth or giving you a Mega-Roth. The way to do that is, as we described, you can put after-tax money, assuming your employer allows it, into your 401k, and then convert that over to the Roth side of the 401k, assuming your employer has that. That's just a simple way to do it. And as you said, Professor, it's great to have Roth money. Any way.
Oh, it's wonderful.
Yeah.
Is it worth the cost to get it there? That's specific to you.
Yeah.
But if you have it there, it's a great thing.
It sure is.
What's the cost to get it there?
Well, thank you for this, Professor Plum. If we've confused people, I apologize for that, but you can certainly write into us and tell us to explain any portion of this. But honestly, I think for people who are highly compensated, who would like to have money put into a Roth, your money into the Roth world, this can be a great way to do that. So if you have questions on this, you can certainly email us. You can go to luciacap.com, LUCIACAP.com. That's also where you find out all this stuff. We've got blog posts up there. We've got videos. Some of the limits that we have, the limits have changed. They change every single year. If you go back a couple of years, we may not have the correct limits for 2025, but the ideas are all still the same. What hurts
make sure you update for the right limits.
Yes. What hurts is when they change the laws and they say you can't do that anymore. And we have something from 4 years ago that says you can do it. But
or they update the laws and they say it doesn't affect you anymore. Again, the WEP and the GPO are gone.
Oh,
Woo!
man. I don't know. I mean, we can't keep track of all this stuff. So try to watch the latest stuff and read the latest stuff. That's the best way to do it. LuciaCap.com. You want to get in touch with Professor Plum or any Lucia Capital Group advisor, 800-644-1150. That's the number at Lucia Capital Group, 800-644-1150. When we talk about strategies like this, we talk about using the Mega-Roth and all that, it's really helpful. In fact, I would almost say it's vital to have a financial advisor help you to do this stuff. Because if you don't do it correctly, and there's a chance you might not, you mess something up, you don't know about the 5-year rule or whatever it is, it can wind up costing you much more in taxes than you really wanted to pay. It can cost you in taxes and in some cases penalties, which is even worse. Not only is it a tax, it is a penalty tax. So you want to try to avoid that. Talk to an advisor at Lucia Capital Group because they're trained, most of them trained by Professor Plum on how to do this stuff. So give them a call, 800-644-1150, or go online at luciacap.com. Don't forget, you can download this podcast. Well, you're already done that, but you can subscribe to this podcast, Apple Podcasts, Spotify, other places. Make sure that you listen to every single week's episode. You don't want to miss anything, as I tell you this every single week, because if you miss something, you miss a lot. And really, these are great strategies. We try to just stick to strategies here on this particular podcast. Professor Plum, I appreciate it.
Thank you, sir.
Thank you. And we will talk to you folks again next time. For Professor Rick Plum, Certified Financial Planner Professional, I'm your podcast host, Johnny Dean. Thanks for listening, Managing Your Financial Future. We'll talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including the potential loss of principal. No client or prospective client should assume that this information or any component thereof serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Distributions of principal from a Roth 401k are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth 401k was established, whichever is longer. Your investment options are limited with a 401k or a Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.